As we surge towards the looming apocalypse, well, that is, if anything you read on LinkedIn is to be believed, I thought I would take a few moments to talk about volatility. I've spoken at length and written at length about volatility in the past, but it's worth looking at again within simply the pragmatic and practical context of its role, if any, in trading. So this won't be a in-depth discussion of probability theory or statistical mechanics or even the way volatility trading is applied to options trading. It will simply be me looking at a few features that I've noticed over the years and some of the mistakes that people make. The first point I want to make about volatility is a simple one. It is a grossly misunderstood concept in trading, and it is misunderstood both by the novice and disappointingly by the professional. One of my tests for figuring out whether somebody actually really knows anything about trading is to listen to any discussion points they bring up about volatility. Generally, this is a wonderful litmus test to ascertain whether somebody really quite bluntly knows what they're talking about or not. And the first point I want to make is that trend and volatility are invariant. They are not the same thing. And this is a major point of confusion. People automatically assume that volatility is trend and trend is volatility. They are not the same thing. And once you understand this dislocation, you begin to understand the role volatility may or may not play in trading. If we were to define volatility in very, very simple terms as it applies to trading, it is simply this. It is the speed and dispersion of price. To put it even simpler, it is how far and how quickly. Literally, given a set volatility and a set time frame, what can I expect? What is the cloud within which I might see prices trade during that period? And this is the best way to think about volatility. It is actually a cloud, and within that cloud, at any given time during a particular time period that volatility is measured over, there is a chance that price will trade at that point. But the nature of it being a cloud and the nature of it being uncertain is immensely important because it is an expectation, not a prediction. Traders unfortunately latch onto volatility numbers and assume that is telling them something about where the market will trade. And they base their trading strategies upon that, not understanding that there is a sharp distinction between expectation and prediction. So generally what happens in their mind is they see a chart like this, which is the ASX 200. The red line at the bottom is the 30-day historical volatility, and when I snapped this chart, it was sitting at 25%. So what they instantly do is they go, well, the market is in a downtrend, the volatility is 25%, therefore the current value minus 25% gives me a target of 53.62. They then put this chart on LinkedIn and say they've made a prediction. And generally all they end up doing is looking like a dick. Because that's not what volatility is telling us. Volatility is telling us that from the point I measured this chart, based upon the 30-day historical volatility, there is a probability that price will trade in a range somewhere between the close of this day and plus or minus 20% in 30 days' time in very, very simple terms. It is not telling you that the market will go down 25%, therefore you buy deep out of the money put options in the expectation that you will make a killing. The other practical point for volatility, and this relates very much to this notion of a target, and particularly targets within trends. is that volatility has no direction. There is no such thing, despite what this little news clipping I took from Investing Daily says, there is no such thing as downward volatility. You cannot ascribe a direction to volatility, nor by extension does it have a bias. And this is a difficult point for people to understand, but it comes back to this notion that it's an expectation, not a prediction. That somewhere in this period, measuring this volatility and this time frame, we will see price trade. Or, no, let me rephrase that. There is a probability that price will trade at one of these points. The thing you have to avoid in your language is a perception of certainty, because that's not what volatility brings, and that's not what volatility measures bring. They bring a range of alternatives to you. And again, the thing that is most important to you is not those range of alternatives, but rather what price is doing at this current moment. Which leads me to this point. Volatility won't tell you how much you may make. And this is a mistake people make. They assume instantly that because they perceive something to be a very high volatility, then that will instantly make them a great deal of money. What I've done in this slide is a very quick and dirty little matchup that I'll walk through. What I've done is I've taken the year-to-date 10 best performing commodities and the year-to-date 10 worst performing commodities from a list I keep. And I've looked at their year-to-date change, and I've looked at their 30-day historical volatility at the time of snipping this. And I've mapped the two. And what you get is something very interesting. You get seemingly no relationship between the volatility of an instrument and its performance. And that is to be expected. Now, this is quite dirty and it's very blunt, and there is a nuance to this that I will walk through. And if we look at natural gas has been one of the standout commodities year to date. 107% return, but its 30-day historical volatility is sitting at 96.4%. And the instant assumption is that, well, that's very high. But the question is a simple one. The question is, in relation to natural gas, is it very high? Let me use a crude analogy. If you're driving in Australia and you're driving at 150 kilometres an hour on one of our freeways, you are well over the speed limit. Based upon our experience and baseline and average speed limit, you are well over the speed limit. If I was doing 150 on an autobahn in Germany, I would probably get a hurry along because I'm not going that quickly. Volatility within instruments is extremely nuanced, and you cannot generate benchmarks that are universal. You cannot say that natural gas at this point in time has an historical volatility of 96.4%, which when compared to oats is 38.2%. Therefore, it's much more volatile. In very, very, very simplistic terms, you can say that, but in reality, that's incorrect. Because volatility is idiosyncratic to the instrument you are trading, which means that if I were to make a judgment about natural gas, whether it had high or low volatility, what I actually have to do is break the volatility down into, well, what is its long-term average? And then if I was going to be sort of super pedantic, I would then break that down even further into quartiles. And this is actually what we do in options trading. So simply stating that a volatility of X is high for an instrument doesn't make any sense. For example, if we look at this chart of natural gas, And let's assume we caught this breakout of congestion here where price makes a double bottom, breaks out. The initial point of this move occurs at what I've marked as the long-term historical volatility for natural gas. It makes a 47% gain during a time when it is experiencing lower than average volatility. The next part of the game, 45%, is made as volatility is above average. So you can see blanket judgments and statements about volatility don't really work because of the nuances within each individual instrument. We can see this in an intriguing way when we look at even stocks. This is Chalice Mining, one of the best performers we've had of, let's say, the past 15, 18 months. And I've marked the long-term historical volatility here. And you can see, other than that hump where price has the initial lift, the big move for this stock has come when volatility is what you would perceive as being average for this instrument. But there is a quirk in this, and the quirk comes about because of price. If we look at Chalice, and this is a monthly chart, and it shows that Chalice has been going sideways for effectively years. The bump that we see here is an artifact of that very, very long-term congestion being broken. So in many ways, the data's not telling you the correct story about what's occurring with volatility. Once again, we have to be very, very careful. But what is intriguing about volatility is that traders are entertained by perceptions of volatility. You get these nonsense statements that say, well, markets need to be volatile for you to make money. That's not true at all. And that's confusing volatility and trend. Remember, volatility is an expectation of how much and how far. Trend is the capacity of price to autocorrelate. And so at the end of the day, what we are looking for are not changes in expectation, but rather the reality of what is occurring with price. And this is Caltex. And so we're looking for this sort of long-term move. Now, within this move, there will be periods where volatility is higher than expectation. It is lower than expectation. But in no way does it alter what the trend itself is doing. In no way does it alter the approach you take to trading this. Because at the end of the day, and this is the most important point, I think, of this little rant, it is simply this. As a trader, you are paid by price, not your perceptions of volatility, nor your desire to be entertained by it.